at the beginning, and then on 12/31/16, which is the end of the lease term, do we have an additional payment of $1,751? No. We've made all of those payments. So what happens on this date is the guaranteed residual value. One of two things are going to, well, one of three things are going to happen. Either the asset is still worth at least $2,000, something more than $2,000 is fine, and we give it back. And that's all you have to do. You can give back an asset worth $2,000, or the asset is now worth nothing. We throw it in the garbage and we give them cash of $2,000. Or the third option is we're somewhere in between the two. We give them the asset whatever it's worth and we make up the difference with cash. So one of those three things are going to happen. No matter what, you're giving them an asset worth $2,000. Could be cash, could be a piece of equipment. We still have a liability, and so we still have interest. 148 would be the amount that we calculated, which reduces it by 1852. We're off by $4 because of rounding that we've done, but essentially it goes to zero at the end. If we didn't round it, if we did to the penny, it would be right. We're off by $4 because of rounding. So this looks just like our bargain purchase option table. Nothing is different here. The difference will be right here in our journal entries. So let's think about this last date right here, 12/31/16. So we're gonna do this completely because on the exam you're gonna ask to do it completely. One thing we know is gonna happen on this date for someone, for every one of these problems, we know someone's recording depreciation. So make sure and don't forget about that. Someone's gonna be doing it, so let's just do that one first. So the lessee still holds this asset, even though we're now all the way here, they're still holding for this last period. So they depreciate it for this last period. So we're going to record depreciation, it's going to be the exact same amount as before. And so we're going to have depreciation expense of 1,333, and we're going to have accumulated depreciation of 1,333. Okay, just so we don't forget to do it, we'll just do that one first. And to be honest, that might be a good strategy for the exam is, work through a problem, just do all the depreciations first. Make sure you put those in the right places, and then go back and do the rest. Because it's a common thing to forget the depreciation. All right, so the next thing we need to do is we need to figure out what is this journal entry going to look like. Well, we know we're going to have interest expense of 148, so let's go ahead and put that here. So we're going to have interest expense of 148. And why do we have interest expense? Because we still have a liability on our books. So now what we're going to do is we're going to take off the rest of that liability, which is this guy right here. And it's off by a couple bucks, but we'll just go ahead and use that number anyways. And so we're going to get rid of the lease payable, which is the account that we put on at the very first. And we've been getting rid of it a little bit at a time. What's left is this amount. I just lost the number. It's here somewhere. Oh, 1852. Okay, we'll take that thing off. Are we making a cash payment? No. But we are going to give back the leased equipment. So we take it off of our books. So leave a space here. We're going to credit the leased equipment to take that thing off of our books. Why? Because we're giving it back, so it's not ours anymore. And that's still in our books for $10,000. We also need to get rid of accumulated depreciation, because that contra asset associated with the leased equipment, it's not ours anymore. We've got to take it off of our books. How much accumulated depreciation do we have as of this date? 8,000, because we depreciated over 6 periods. Split up the 8,000 between 6 periods. We now have $8,000 worth of depreciation. So we'll get rid of $8,000 in depreciation. Assuming the leased equipment is worth at least $2,000, that's the journal entry. We're done. We got rid of the asset, we got rid of the contra asset, we got rid of the payable, we recorded the interest expense. That's it. There's nothing else we have to do. What if the asset is worth less than $2,000? We do the same thing. We get rid of the leased equipment, we get rid of the accumulated depreciation. What changes? No, lease payable doesn't change. There's going to be a credit to cash, right? So let's say we have to pay him $1,000. Credit cash $1,000, debit what? estimated this thing, we ended up being wrong, we have a loss because of this. Credit cash, debit loss. Could we ever have a gain here? Not possible. So you can have a loss up to $2,000, or as little as $1, right? You have to pay $1 to make the difference. Or nothing, which is the case that we have here.
Without drawing the table, how can it, what is the easy way out to get the 148?
That is an excellent question. That is an excellent, excellent question. The easiest way to get the 1852 is to realize what this number is. This 1852 is the present value of $2,000 brought back one period at 8% interest. Okay, so, and that is a very good question because that's something we have to think about. Well, if I didn't do this whole table, how would I get this number? You will have to do this on the exam. The amount that's left in this lease payable is the present value of the lease payable, or the amount that you're going to have to pay. The present value to $2,000. So bring $2,000 back one period. By definition, it's this number right here. Does that make sense? That's how you do it. Present value of either the bargain purchase option or the guaranteed residual value brought back one period is going to be that amount. So you don't have to do the whole table. You just need to be aware of what that number has to be. All right, from the lessor's perspective, very similarly, they're going to have, well, slightly different. They're going to get the asset back. And so let's call this inventory for them. And we'll assume it is worth $2,000. And we'll talk about what it's not. They're going to record interest revenue of the 148. And they're going to have get rid of their lease receivable for what's left, which is going to be the 1852. So they don't have to do the depreciation, and they don't have any cumulative depreciation they have to get rid of. They're just putting the asset back on their books for the $2,000 that it's probably worth. Now, there's actually two things that could happen for them. If it's worth less than $2,000, what changes in this journal entry? Okay, the inventory would be worth less, and what else changes?
Cash.
They're going to be debiting cash, right? They're going to get the cash from the lessor and from the lessee to make up the difference. What if, when they get it back, they think it's worth more than $2,000? Then they're going to increase the value of the inventory, and they're going to have a gain at the same time. So, the lessee can have losses, but not gains. The lessor can have gains, but not losses. Does that make sense? Why that's the case? So in other words, because of this guarantee, they're either getting $2,000 back or something greater than $2,000. And because of the guarantee, the lessee has to pay $2,000 back, but it doesn't matter if it's above $2,000, it can't be below the $2,000. So they can have losses and they can have gains, or in this example, neither. It's worth exactly $2,000 when they get it back. Any questions?
So they won't have, the lessor won't ever have a gain. I'm sorry.
It'll be one or the other. One person will have a gain, the other person will have nothing, or the other person will have a loss, and the other person will have nothing.
So if the asset comes back less than the residual value, then they just decrease their inventory and receive cash.
Correct. So very specifically, if the asset ends up being worth less than the guaranteed amount, the lessee has a loss. If it comes right at it, nobody has anything. If it comes greater, then the lessor has a gain. That's essentially what happens. All right. Guaranteed residual value. The reason that I went through the entire problem instead of just the essential parts is for one more practice of the entire thing. So there's another example of a capital sales type lease with this additional thing, the guaranteed residual value included in it. All right. Unguaranteed residual value. We do not go through the entire problem for this one. we just talk about the idea and we give the one journal entry that's going to be different. With an unguaranteed residual value, it basically doesn't say anything in the lease contract about what happens with the value at the end. Just doesn't say anything about it. But we still have expectations of what we think it's going to be. So in this case, $10,000 is the same payments, same lease term, 7 years, going to be a capital lease for the same reasons. This time it just says that the grinder is expected to be worth $2,000, but not guaranteed by anyone. This is just what everyone thinks. So exactly the same information, but this time they just think it's going to be worth $2,000, but no one guarantees it at $2,000. Same thing, $8,000, so it's going to be a sales type capital lease for the lessor, and then 8% is the market rate of interest. All right, so something interesting happens here, but it's only one thing changes between, well, let me think about that for a second. This is the essential thing that changes. There could be some other things that change, but this is the essential thing that changes, and so this is what we will show. In the example problems, you'll have one that deals with an unguaranteed one and goes through the entire problem. And you'll have the solution so you can look at it. For this one, we're only going to look at the most important change, which is this guy right here. What happens at the very end might be slightly different from what we've done previously, but you can think through that and figure that out on your own. So specifically for the lessor, the difference that's going to happen here is going to be this. So first of all, from the lessor's perspective, they're still going to record a lease receivable for $10,000. Okay? And the reason they're going to still have a lease receivable of $10,000 is their expectation is that they're going to receive lease payments of whatever that number was, the $1,751, because everything's going to be the same as the last problem. They're going to receive 6 of those, and then they expect to get an asset back worth $2,000 at the end. That's their expectation. And so the present value of the minimum lease payments is going to include the $2,000, and that gives us the $10,000 amount as our lease receivable. They're going to get the payments plus an asset worth $2,000 back at the end. That's their expectation. Not guaranteed, that's what they expect to have happen. The sales revenue number that we're now going to record cannot include the expected $2,000 at the end. Why? Because they didn't sell it. The only thing they're selling is the portion that's being used up, and then they're getting back the residual amount. And so the sales revenue cannot include the $2,000 residual value. So what we have to do is we have to take the present value of the minimum lease payments, which is $10,000, and subtract the present value, and this has to be the present value of the expected residual. And we already know what that number is. It's the 1,260, because we already figured that out for the previous problem. So the difference between those two numbers, which is the 8,740, this is the amount that they're actually selling. The rest, they're just getting back. This is not part of the sale. And so the sales revenue is going to be 8,740. That makes you uncomfortable, doesn't it? Debits don't equal credits. Well, they will in just a second. You gotta do the rest. Alright, so skip a space. We'll do cost of goods sold, forget the number here in a second. We're also going to reduce the inventory, just like we did last time. The inventory on our books is $8,000, so let's go ahead and reduce our inventory by $8,000. But our cost of goods sold is not $8,000, because we're giving up this asset, but then we're getting back a portion of it. So our cost of goods sold is not $8,000, it has to be something less than that. Once again, it's the $8,000 minus the present value of what we're getting back, which is going to be $6,740. So $6,740 is our cost of goods sold. Now our debits equal our credits. It looks funky though, doesn't it? That is the way it is done. So just like with the guaranteed residual value, the lease receivable and inventory are the same numbers. So the journal entries from here on, except for maybe the very last journal entry, are going to be identical. Because your lease receivable, and from the perspective of the other person, nothing changed for them. Everything would be exactly the same. So from the perspective of the lessor, the lease receivable is the same, so all the journal entries moving forward will be the same, except the very last one. With that for a second, would it be the same? Assuming the assets are worth $2,000, it would be the same for them as well at the very end. Now, if it's worth less than $2,000, they would have a loss. If it's worth more than $2,000, they would have a gain, because they get whatever is worth back. All right, any questions about that? The textbook has an example that goes through the entire problem for this, I'm pretty sure. So if that's not completely clear, look back at the textbook, it has an example that does this. All right, treatment of residual value. 45 minutes. I'm going to ignore this for now because we don't have time. So feel free to look at this on your own. This kind of gives you a summary of what we do with residual values, if it's guaranteed, not guaranteed. And then it has this additional thing which we haven't talked about. You can just think about it on your own. What happens if it's not the lessee guaranteeing the value, if a third party guarantees it, then something slightly different happens. Textbook talks about it. We don't have time to talk about it tonight. I apologize. Our next topic, executory costs. Okay, we're going to have to skip a couple things in here, I think. But we can't skip executory costs. All right, executory costs. One of the responsibilities of ownership that is transferred to the lessee in a capital lease is the responsibility to pay for maintenance, insurance, taxes, anything associated with the upkeep or the regular use of this asset. These are referred to as executory costs. So we've already talked about them previously, that it's usually the lessee's responsibility to maintain the asset, right? Remember that? Talked about that previously. So these maintenance costs are called executory costs. So in this first example, it's super straightforward. This is just saying if the lessee does have that responsibility and they maintain the stump grinder, what would be the journal entry for the lessee? Well, they would just have some kind of an expense. We'll call it maintenance expense. And in this case, $200, and they credit cash $200. So that's what happens every single time they have to pay for taxes for this thing, or they have to pay to have someone maintain it in some way, grease it, oil it, whatever you're doing, whatever this thing is, to maintain the asset. When that happens, it would just be credit cash, debit, and expense. That's it. The lessee will just pay for it whenever that happens. The complication comes in when we have executory costs that are part of the lease contract. In other words, instead of having the lessee maintain it, sometimes the lessor maintains it, but then charges the lessee to do so. So a common example of this is the way the copy machines are generally leased out. Generally, if you lease a copy machine, you don't pay someone else to then maintain it for you. Instead, you pay an additional cost to have the person that's leasing it to you maintain it for you. That's usually how copy machines work. There's probably other examples, but I can't think of any off the top of my head. I'm sure there's other ones. So, sometimes a lease contract will specify that the lessor is to pay executory costs, but that the lessee will reimburse the lessor through higher lease payments. And so here is the key idea. Any portion of lease payments that represent executory costs is not considered part of the minimum lease payments. So, if you're making lease payments of $800 a month, but if you maintain it yourself, that will only be $600. The additional $200 is not part of the lease payments. They should be treated this way. Expensed as incurred. And we'll deal with the journal entries in a second. The lessee simply expenses executory costs as incurred. So here is an example. All right, so on January 1st, Guy new lease a summer grinder from Blunt Corporation at a price of $9,985. The lease agreement specifies annual payments. 7 years, estimated useful life is 7 years. The Blunt manufactured the grinder at $8,000, so it's a sales type, capital lease. Payments are $2,500 and include maintenance expense. So if we go back, this problem is identical to the sales type, well, essentially the direct financing one we did at the very beginning, except it's a sales type one, which doesn't really change anything. So it's essentially exactly the same as this guy right here. Is that the right one? 9985, yeah, 9985. So it's identical to this one. You might make a note in your notes that that's the case. So it's identical to our first direct financing capital lease, except it's a sales type one. Other than that, it's identical to this one. But instead of making payments of, we figured out they were $2,000 each, they're going to make payments of $2,500. So the difference between the $2,000 that they should be paying for this lease and the $2,500, that $500 are executory costs. And so this is what the journal entry would look like. So instead of, and you're going to have to think through what happens after this, because this is all we have time for. So when we make this first payment right here, credit cash $2,500 instead of $2,000, it would just instead look like this. We're going to credit cash $2,500. We're going to debit the lease payable for $2,000, just like we did in the previous problem. And then we're going to have a prepaid, we'll call it maintenance expense of $500. So why is it a prepaid?
Because
We haven't actually used it yet. So when we get to the end of the period, this will not become a prepaid, it will become an expense. And then a new prepaid will replace it. And so from the other perspective, we get cash of $2,500. We would have reduced